And happy Friday, and it is a happy Friday because investors, well, you're probably making money today. Stocks across all shapes and sizes, big cap down to small cap, whatever, having their best week of the year. But as you also heard at the top of the show, some are worried about a real economic slowdown. If that happens, what would it mean for stocks? Joining us again at Post 9 to talk about it is Morgan Stanley's Chris Toomey. He runs one of the highest-rated private wealth advisory teams in all the land. Chris, so great to get some free advice. We appreciate you coming down here.
Thanks for having me.
You made the comment that rate hikes are not like a cobra bite, where you get bit and then you see the effects right away. It's more like a boa constrictor, where it's a slow, horrible process. I'm not sure I like the analogy. But that said, what do you mean by it? And it sounds like you feel like it's going to take a while for us really to feel the impact of these rate hikes.
Yeah, I mean, I think we are starting to feel it. I think everyone recognized that rates higher for longer was going to be a problem for the economy. Mm-hmm. And I think it's the issue that we're seeing is it's just taking a longer time for us to see it affecting the economy. I think if you look at why that is, I think it's the tremendous amount of liquidity that was put into the system during COVID. And now we're starting to really feel kind of the air coming out of the economy. That debt situation, that debt problem, we saw it last week with regards to the Treasury and the amount of issuance you're going to see there. You've seen it in the corporate markets with regards to the fact that corporates have been a lot less likely to issue debt in this market because of the higher rates. And I think the biggest problem that we're starting to see is the consumer. Consumer savings rate is now at 3%, well below historical averages. Yeah. And if you look at credit card debt, it's over $1 trillion.
But I'd push back on that because I've looked at it. I would say you're right. The overall credit card debt's up, but debt service as a percent of income is still what appears to be a manageable level.
Depending on your quartile, right? So if you're somebody in the bottom quartile or third quartile, paying 20 to 25% is not going to be an easy thing to do, even if your income is going up, right? So if you look at just the basic math on that, $1 trillion at 20%, that's $200 billion that isn't going into the economy, that's coming out of consumers' wallets. Then you throw in student loans, then you throw in any of the other issues that are being financed now, whether you look at autos or other parts of the economy. This is a weight that is going to start weighing down on the overall economy.
And I do worry about the middle class. There was and I'm going to get this. I don't want the viewers or listeners to hold me to the number because I'm just going to pull it from memory, but it is directionally correct. According to Equifax or TransUnion, one of the two, half the people who had student loan debt deferred for 3 years bought a home or a car or both. So they weren't paying into student loans, so they just bought something else. And that's great for them, except I'm now worried they're going to have both those payments or triple payments.
Exactly.
And some of those payments going up. And I just don't, with everything else inflationary, I do worry, how is that going to ultimately play out through the economy? You can't live on the credit card forever, can you?
No.
I mean, unless you're the U.S. government.
Yes, exactly. But that might not necessarily be the case, as we saw last week, right? The concern right now is if you look at the servicing that the U.S. Treasury is doing on its debt, it's well above what we'd expect. So
but they can print money and Joe Sixpack in Ohio can't.
Right. That's true. But what you can see is a crowding out effect in the Treasury market, which is affecting other parts of the market, right? So if the Treasury is issuing more and more debt because the interest on that debt gets higher and higher and the deficit gets larger and larger, you have other people that are going to be leaving the corporate market to buy Treasuries, leaving the corporate market and high yield market to buy Treasuries, and leaving the equity market, which we're seeing this year, and buying Treasuries, right? Yeah. Getting 5 to 6% for a lot of investors, if your required rate of return is 7%, that's pretty good right now.